I'd like to welcome you all to this revision series on financial accounting. Before me are some questions from the SEC mock exams, and I want to go straight. Question 1 says, which of the following calculates a sole trader's net profit for a period? This question comes out of incomplete records, and I hope you still remember your business equation, which looks like what I have in front of you right now. Profit is equal to closing capital minus opening capital plus drawings minus capital introduced. So all you need to do is to play around with those variables and see which one will fit in. Now, net assets also means capital. So everywhere where we find net assets, please let us remember the word capital. A says closing net assets is positive, which is correct. And then drawings is positive, which is also correct. Then capital introduced is negative, which is correct. And opening net assets is opening capital, which is also correct. Excuse me. And then we have got B, which says closing net assets is positive, which I agree with. But drawings is not supposed to be negative. And I think that is also seen under the option B. You have got D, closing net assets is positive. Drawings is positive, which is correct. Capital introduced is supposed to be negative. All right. I think the only thing that is wrong with D is capital introduced. So I'd like for us to go for that option A. That is our correct option there. This is the theory question. This is the theory question. All right. Progress to the next question. And which question is that? This is question 2. Says, which of the following explains the interest system of operating petty cash? A says weekly expenditure cannot exceed a set amount. And then B says the exact amount of expenditure is reimbursed at intervals to maintain a fixed float. And then C says all expenditure out of the petty cash must be properly authorized. We need something that is connected to float management. And then D says regular equal amounts of cash are transferred into petty cash at intervals. Okay, so let's begin to use what we call the elimination method and see which one we'll remain with. So, like first of all, to eliminate the option D, we don't always put regular amounts. The amounts we put will depend on how much we've spent. So D is out. And then what else do you have? You have got C says all expenditure out of petty cash must be properly authorized. Yes, we agree with that, but I think this is not connected to maintaining a fixed float or interest system. So I think the competing answers in this case will be A and B. Says weekly expenditure cannot exceed a set amount. Okay. And then B says the exact amount of expenditure is reimbursed at intervals to maintain a fixed float. I'd like to go for B. I think B is the best option in this case, because what is happening under B is that if we spend a specific sum of money, what we need to do is to bring ourselves back to the float. Okay. Weekly expenditure cannot exceed a certain amount may not be correct in this case, because we do not know many times how much we are going to spend. So I'd like to go for B. B is the best option. 3 says, which of the following statements are true of limited liability companies? The company's exposure to debt and liability is limited. That is not correct because it's supposed to be the shareholders' exposure to debt, which is supposed to be limited. Then 2 says financial statements must be produced. Yeah, that sounds correct. And then 3 says the company continues to exist regardless of the identity of its owners. Okay, that also sounds to be correct. So I'd like to reject 1, where these companies are supposed to be shareholders. That is the reason why 1 is wrong. But I'll take 2, companies' financial statements must be produced, whether you're a private company or a public company. And then 3 says the company continues to exist regardless of the identity of these owners. That's correct. So I'd like to go for C. Let us go to question 4. Says Anne is a sole trader who does not keep full accounting records. Following details related to our transaction with credit customers and suppliers for the year ended 30th June X6. What figure should appear for purchases in Anne's statement of profit or loss for the year ended 30th June X6? So you might as well run with a T account. We are supposed to ensure that we do the correct thing here. Yeah, just let me just work out something here that will help us. So I'll call my account. Let's see, payable, ledger, control. Yeah, and I have the dollar sign. I think not quite sure. Okay, so maybe this side we can say debit, and the other side we can say credit, and you keep on following like that. I'll be going from time to time, check what is happening. Trade receivables is not relevant in this case. Trade payables when we opened was 60,000. So brought forward, you're right there, 60,000, please, and you need to be asking questions. Of course, you can ask me questions when we meet. Cash received from customers not relevant. Cash paid to suppliers 302,800. So I would like to say bank there. 302,800. I put it there. Next, what else do you have? Cash discount allowed, not relevant. Discount received 2960. So that one comes there. Let me write it in advance. 2960. Write you in advance. Okay. Supposed to remove that. It's called discount. Okay. Let's progress to the next one. What's the next one say? Contra between payables. So contra will be acceptable. 2000. So contra is always on the reducing side of the account. 2000. What else do you have? You've got trade receivable closing balance, which is not relevant, and then trade payable closing balance 84,000, which I think is relevant. So we see carry down. Memory serves me well. So what we're looking for is the purchases for the period. Okay. So all you need to do is to balance your record. You sum up on this side, and you also sum up, put the same. See, on the other side. I hope that you're seeing what I'm doing. Okay, it's supposed to be skisty. Supposed to be skisty there. Okay, so what's the difference between this figure and that figure? I'm getting that figure there, and I hope you're getting the same as well. So I'm finding a, wow, what happened? Let me just enlarge that for us. I can see here a 3317 skisty, which I also have on the other side. So that is how you work out that question. I'd like to go to the next question. The best answer therefore there is C. 5 says, which of the following errors would cause the total of the debit column and the total of the credit column trial balance not to agree, coming out of correction of errors? That's the topic. 1 says the transposition error was made when entering a sales invoice, the sales day book, that will result in an error of original entry. 2 says the check received from a customer was credited to cash instead of being debited and correctly recorded in receivables, meaning it was also credited there. So we have got a double credit. So 2 will cause the trial balance not to agree. Then 3 says the purchase of non-current assets was omitted from the accounting records. This will not cause the trial balance not to agree. And then 4 says rent received was included in the trial balance as a debit balance, assuming of course that on the other side we did, when we posted the bank account, the cash account we also debited, we'd still have a double debit in this case. So I'd like to go for the options 2 and 4. In 2 there's double credit, and then in 4 there is also double debit. So D is the option that we go for there. Allow me to go to the next set of questions, and where there's no theory, we may tend to calculations. 6 says, at 31st December, the following require inclusion in the financial statements. And for these items, what total figure should be included in the company statement of financial position? It's a nice question, and we've done this. I think can just clear this. Coming out of I think accrues and prepayments. Okay, let me just write something. On 1st January, let's first of all take note of the fact that our cutoff, our year end is 31st December. I hope that you can see that, this date. But on 1st January X5, company made a loan of 12,000 to an employee, repayable on the 1st of January X6, charging interest of 2% per year. On the due date, she repaid the loan and paid the whole of the interest due on the loan. So on the last day of 31st December X5 means that this loan was still outstanding, and of course to the company this is to be treated as a loan advance to an employee receivable. Okay, I can write that loan receivable was standing at 12,000, and then the interest on that loan was also outstanding by 31st of December at about 2%. So we need to do some bit of work there. Here, let me just do it straightforward. 4,000 multiplied by, that is a figure there. So at 31st, I can write that date so that we don't have to get confused about what is going on. So by that date, we still have an outstanding amount. Let me go to the other side. It says the company paid an annual insurance premium of 9,000 in X5, covering the year ending 31st August 20x6. How many months do we have between January and August? I think it's supposed to be 8 months. So insurance prepaid. What do we have? I'll just work it out here so that you can understand there. I saw 9,000 multiplied by 8 divided by 12. I'm getting a 6,000. Then what else do I have? 3 says in January X6, the company received rent from a tenant 4,000 covering the 6 months to 31st December 20x5. It was not yet paid then. So we're going to include the whole lot of that as rent receivable, 4,000. Rent receivable. Alright, we can accrue for that, 4,000. So if we sum up all these amounts, we are getting with it. We're coming up rather with an exact figure of 22,240. And if we look at our options, we will discover that our current asset cannot be 10,000 in A. That is why A is wrong. Then B says 22,240 current assets. No current liabilities were discussed. And then this figure again for C is wrong, and also for D. So the best option is B, and please, you can counter check that. Question number 7 says the company's statement of profit or loss for the year ended showed a net profit of that much, 83,600. It was later found that 18,000 paid for the purchase of a motor van has been debited to the motor expense account, and it is the company's policy to depreciate motor vans at 25% per year on the straight line basis with the full year's charge in the year of acquisition. What would be the net profit for the year after adjusting for this particular error? So this is coming out of depreciation, of course, and there's an error that we need to correct that there. Let me just get on to that. I'm going to just clear there, redo some works. Here I've got draft profits. How much do I have? If I may remember, I got 83.6. 83.6. Next, there is an error. It was later found that 18,000 paid for the purchase of motor vehicle has been debited to motor expenses. So we treat it capital expenditure as revenue expenditure. CapEx, capital expenditure reversal should be the next entry here. So I'll add back that. We're not supposed to do that. And then what else? To the motor expense account. It is the company's policy to depreciate motor vans at 25% per year on the straight line basis with a full year's charge in the year of acquisition. So we need to still depreciate that amount. So depreciation is equal to, we are told 25%, all right? And of course, when it comes to depreciation, we need to less. So let us see what is happening there. I'm getting a 97, 100. And I hope that's what you're getting as well. That figure there, C. The next question is coming out of interpretations of accounts. Zena has the following working capital ratios. Which of the following statements is correct? So I see my current ratio has declined 1.5 last year, 1.2 this year. And I see that my receivables has increased from 50 to 75 this year. Payable days has reduced from 45 to 30. Then inventory days turnover rather has increased as well. So the following statements is correct. A says Zena's liquidity and working capital has improved. I don't think so. And then B says Zena is receiving cash from customers quickly. Let's check that. Is it true? I think our receivable days has increased, which is wrong. And then C says Zena is suffering from a worsening liquidity position. I think that is correct. D says Zena is taking longer to pay suppliers. No, they're not taking longer. I think you can see the payable days there. They have reduced by 15 days. I'd like to go for C as the best option. This company is suffering from worsening liquidity position. Like to go question 9. Which of the following statements is or are correct? A statement of cash flows prepared using the direct method produces a different figure to net cash from operating activities from that produced if the indirect method is used. And the answer there, the statement rather, is false, because it is not supposed to be like that. It's supposed to be the same. Then 2 says rights issue of shares does not feature in the statement of cash flows. It does feature because the rights issue also results in cash. Then 3 says a surplus on evaluation of a non-current asset will not appear as an item in the statement of cash flows. That's correct, because a surplus on evaluation does not give rise to cash. It's a gain on paper. And then 4 says a profit on the sale of non-current asset will appear as an item under cash flows from investing activities in the statement of cash flows. No, a profit on sale of non-current asset appears under operating activities. So the best option is a 3 only, which is D, and I want to proceed to the next set of questions. I think today we can go all the way up to 15, and then I'll record another video for the other questions. Okay, so now we are dealing with again accruals and prepayments. I think this is also found under incomplete records. The company receives rent from a large number of properties. Total received in the year ended 30th April X6 was 481,200. The following were the amounts of rent in advance and in arrears at 30th April, that is 20X5 and 20X6. What amount, that's the question, what amount of rental income should appear in the company's statement of profit or loss for that year ended 30th April 20X6? And I think this is the time to again open some kind of a T account. So we need to clear what we have there. So we've got debit this side, the other side we've got credit. Rental income account. Okay, I should suppose. Of course, we've got dollars. So there, we've got dollars. Yeah, they're like being ordered, so I'll push these amounts on the other side. I'm just going to show you what we do so that you know what it is that you need to do as well. Let me just push this on the other side. So what we do in this account is, of course, to respect the positions of these figures in advance. Brought forward advance from the previous year, and I'm going to show you that it should be credited. Then brought forward rent in arrears from the previous year should be credited. Okay, then what you put in here as what you receive as money from your tenants should be, of course, credited, because bank is to be debited. Then you say carry down, closing down advance, that is amounts paid in advance for the following year should be put on the debit, and carry down arrears should be put on the, that these are the defaulted amount in the current year should be put on the other side. What we're looking for is a figure to transfer the profit or loss. That's what we're looking for here. So I start now and I begin to populate my account so that you can also follow. Let's begin. We are told that the total amount received in the year, in the first sentence there, is 481,200. And by the way, the requirement is that what amount of the rental income should appear in the company statement of profit or loss. 481,200 comes here. 481,200 comes there. Next, you have got the amounts there. Rent received in advance. So the advance received in X5 becomes the opening balance for X6. And the advance received in X6 is pushed on the other side because it's income for 28.7. So let me start with 28.7 as my advance on top there. I hope that you can see what I've done. The advance for rent in arrears, the advance rather for X6 is 31.2. Yeah, let me push that one where it belongs. I hope that you can see that. And then we have got the arrears. The arrear for X5 should be pushed on the credit side. That's 21,200. Okay, 21,200 should be pushed on the debit side rather, not on the credit side. And then the last arrear there is 18,400. 18,400. I push it where it belongs there, and I try to balance my account without further delay. You will see that that's the figure that I have on both. So this difference will be equal to the difference between the total and the two amounts there. I am getting that figure, and that's the figure that I was looking for. So 475,900. Do we have that? Yeah, I can see a D there. Hope you also have the same figure. Question 11 says, which of the following differences between sole trader, which of the following rather are differences between sole traders and limited companies? One says sole traders' financial statements are private, never made available to third parties. Then a company's financial statements are sent to shareholders and may be publicly filed. In the case of a public company, that's correct. Then 2 says only companies have share capital. That's also correct. Then 3 says the sole trader is fully and personally liable for any losses that the business might make. That's correct. And then 4 says drawings would only appear in the sole trader's financial statements. That's correct, because in the company's statements we have got that. All right. So now the challenge that we may have here is the fact that we only have 3 options. So we should also try to use the elimination method. All right. The elimination method here might help us. Okay, so let us try to remove the unlikely, the most unlikely answer, the answer that is unlikely, so that we can remain with what we can remain with. Okay. 1 says, again, we look critically at that. So traders' financial statements are private and never made available. So the word never there is a bit challenging. Why? Because when a sole trader needs, let's say, bank loan, they may still need to prepare what? Financial statements. So avoid the word extreme. The extreme word, rather, never. And that's so I think where there's one with garbage. But so the other answers all look to be correct. 2, 3, and 4 like to go for B. 12 says, which of the following statements is true? It says the interpretation of an entity's financial statements using ratio is only useful for potential investors. Not only investors, but I think also managers. Ratios based on historical data can predict the future performance of an entity. Many times history does not predict current conditions. Then C, the analysis of financial statements using ratios provides useful information when compared with previous performance or industry average. That's correct. Without comparisons, ratios are meaningless. And then D says an entity's management will not assess an entity's performance using financial ratios. They will. I like to go for C. Okay, next. I've got 13. A company's motor vehicle cost account at 30th June X6 is as follows. And the question is, what balance should be included in the following periods drop balance for motor vehicles cost? 1st July X6. So the opening balance for the following year will be the closing balance for this current year. All right. So then the closing balance for the current year is 36,750. Of course, this other side is carried forward, but following year it will be a debit. So I'd like to go for A, 36,750 debit following year. Okay, so finally, let us look at the last 2 questions and then see if we can bring this to a close. Okay, want us to look at 17 questions. It is still fine because we've got about 35 questions. So if we can do half of that, that will look good. I will be sending you more work bit by bit. Hope that you can go through this because you need to succeed in the next exams. 14 says, which two of the following rather items must be disclosed in the note to the financial statements for intangible assets? Coming out of IS 38. The useful lives of intangible assets capitalized in the financial statements are disclosed. Perhaps that can be. And then 2 says a description of the development projects that have been undertaken during the period. Of course, that might be we might have a limit on or a question on materiality there. Then 3 says a list of all intangible assets purchased or developed during the period. Again, a list of a limit or a question of materiality there might deter us from doing that. Then 4 says impairment losses written off intangible asset during the period. This one is correct as well. So I'd like to go for 1 and 4 only. I think the others are quite too detailed because of the question of materiality. So 1 and 4 we take. Then 15 says, which of the following statements are correct? Capitalized development expenditure, again still dealing with intangible asset, must be amortized over a period not exceeding 5 years. There's a limit there, which is not good. There's no limit. Then 2 says capitalized development expenditure as shown in the statement of financial position under the heading non-current assets. That's correct. And then 3 says if certain criteria are met, research expenditure must be recognized as an intangible asset. I think the word certain is ambiguous. It's supposed to be a complete parrot criteria met. And so I'd like to go for 2 only, which is A there. Okay, interesting. Do I have the time for 16 and 17? Let's see if we can just do those quickly and then we shall close. The following transaction relates to Rashid electricity expense ledger account for the year ended 30th June 20X9. What amount should be charged? The statement of profit or loss in the year ended 30th June X9. We have to get on to the T account again, and I'm so glad that there is some data here that we can run with. This is an expense account, so I need to clear content. What do I have here? Electricity. I need to change that. Expense account. Okay, so again here, brought forward area. Not area, but advance. Let me just follow the question, please. We have got a prepayment brought forward of 550. The prepayment, the brought forward prepayment should be put on the debit side, please. Okay, 550 it is. And then what else is there? There is a cash amount 54. So that cash here, which is a 54. See, when you make payment, you credit bank, debit the expense account. Then across carried forward, there is a 650. There, so if you have got an accrual, of course you put it on the debit side because it's a current year expense. So then the transfer to the profit or loss will be the sum of the figures that we have. If I may just sum it up, and also here sum it up, and also there sum it up. Okay, that's what you have there. 69, 65, 90 rather. 65, 90. Is that correct? I think I could have made a mistake on one of my figures here. So 550, 54, 650. Let me just check. 550, 54, 650. It's supposed to be 650 there. Okay, so I've got that figure. A is the correct option there. Okay, 17, last question, and I will be closing this session. I hope that you can come up with questions on the other side. 17 is coming out of control accounts. Is it? It's coming out of allowance for receivables and the recoverable debts. What figure should appear in the statement of profit or loss for the year ended 30th June 2006 for receivables expense? Yeah, so we have that question there. I'd like to run with my tabular way of doing this work, and then you can always ask questions on the other side. So what do we have? Dollar sign, of course, brought forward, if I may, closing balance for receivables. How much do we have? I saw if 517,000. Okay, that's 517,000. That was quick. Then we are told in the question it was decided to write off 37,000. Can I read that one? At 30th June X5, the company's allowance for receivables was 39,000. That's the opening allowance. At 30th June, trade receivables totaled that much, 517. It was decided to write off 37,000. The receivable allowance was to be adjusted to an amount equivalent to 5% of the trade receivables. What figure should appear in the statement of loss for the year ended 30th June X6 for receivable expense? So what do we have? Let's do some bit of work here so that we can make progress to the next end there. All right. So, written down amount should be removed from there, which I have 37. Okay. And then the net amount is the amount on which we base our receivables allowance, which is standing at how much? Let's do some bit of work there. Supposed to be 5%. I'm going to do some bit of work there. That's the closing allowance. Opening allowance. Opening allowance was given. And I'm not supposed to delay too much here. When I look at that, 39, of course. I've got a 39 opening allowance. And I have to make some comparisons here. I opened with 39 and I'm closing with 24, meaning that there's a reduction in my allowance of about 15,000. Therefore, the total expense will be, and I need to just be a bit more clear here. The recoverable debt is an automatic expense minus the reduction. Remember, this is treated as other income minus the reduction in allowance, which is that much. That gives us how much? Let me just try to do some bit of work here. That is 22,000. Hope that that's what we have on the other side. So I've got that 22,000. Thank you very much for listening in. I hope that you can come up with questions on the other side.